Still morning. Good morning, everyone. Good to see everyone here today, and thanks for the invite, Cinnabar. Appreciate it. I think I got the raw deal on the topic because I'm no pro on cryptocurrencies. In fact, after our presentation today, you should probably see that we juxtapose perfectly with anyone that would invest in a cryptocurrency. And we also don't invest like Benjamin Graham. So we kind of find ourselves betwixt and the ham in the middle of the sandwich of this discussion. But what I decided to do, and obviously would like to speak about Northstar, but I'd like to first give some insights very briefly on the blockchain and crypto, and that's going to be very brief. Then I'm going to give some insights on Benjamin Graham, and then lastly, I'm going to discuss Northstar, just to do justice to the actual subject matter. And I think I'll start with my comments on the blockchain and Bitcoin. And I apologize to the next speaker who's going to be dealing with the subject in much more detail. But we don't actually have an issue with the blockchain at all. In fact, Naspers owns a percentage of Luma. Don't know if you're aware of that. So they're investing in the blockchain currently. But you know, the way we see the world is the blockchain is effectively a public ledger, an encrypted ledger. Computers verify and settle transactions will be done much quicker under the blockchain, and it potentially eliminates settlement agents, which is a big disinflationary force in many markets, including potentially the stock market, and reduces the costs and increases the speed of verifying, recording, and settling transactions. So really, you know, we are not in the space where we believe that there isn't a future for blockchain. We have a different view when it comes to some of the currencies that are emanating out of the blockchain, though. And these smart contracts, which are effectively simple programs that are embedded in the blockchain with a whole lot of rules around how you get currency, we don't buy into that. And it's not that we don't think there is a place for these currencies. It's just the speculation around them that concerns us. So I've got one video clip on, call it coins, and another one that juxtaposes the view. So the one is quite a positive outcome for blockchain and Bitcoin. The other is quite negative. Before I get onto that, I want to discuss Benjamin Graham. All right. So he was known as the father of value investing, as I'm sure you all know, and he wrote two books. One in 1934 called Security Analysis, and the other one in 1949 called The Intelligent Investor. Has anyone read either of those books? How long did it take you? I bet you are. Most people answer like that. They don't finish them. And I can tell you something else. If either of those books were a prerequisite for analysts getting into the market would be 70% smaller. Because it's tough to get through those books. He taught Buffett. So he taught at Columbia, if you know that. Buffett was a Columbia grad. And what I take out of, I've read these books, probably because I'm 48, I could get through them. But the little bit I get out of Graham, well, I get a lot out of him, but the main features are discipline. So before he came along, there weren't investment processes. I mean, he was born in 1894. So he created the investment process that a lot of managers follow today, particularly the deep value managers. He distinguished between what the market does, the psychology of the market, and what companies are really worth, and that comes through in our presentation. He believed in buy and hold, very much what we do. He believed in margin of safety investing, very much what we do. He also, however, believed in cigar butt investing. We don't. And you'll see that clearly come through in our presentation. So Buffett cloned this term cigar butt investing. And he cloned it on the very professor that taught him. And in that time, there was something called net investing. So you take the assets of a company and hopefully you get a discount to the actual asset value of the company. And you buy companies at a discount to the asset value. Markets don't normally do that these days, unless it's something terrible like Group 5. But as a general rule, there aren't many companies trading at a discount to their net asset value, which was the time when markets were very inefficient under Graham and during his tenure. So cigar butt investing, Buffett didn't like. We don't like it. We don't want to buy ultra cheap companies. And I'll give you a description in my mind, or an analogy of what I see. This is your province, so you know Hillbrow. Hillbrow has a block of flats filled with people that don't want to pay rent. The block of flats, to replace it, might cost $50 million. But you don't get 1 cent of rent out of it every month. In fact, if you go there, you're likely to lose your life. So what you will find is that Graham would buy that block of flats because he can get it for 10 million rand. And you'd sit on it forever, amen, till Hillbrow hopefully lifts, not get any rent, that's a cigar butt, and pray to God that at some stage the value keeps on rising and they break the block of flats down and rebuild a building right there and he makes a fortune. Buffett had a different perspective. He said, don't go near that building. Rather buy a building that gives you rent every month and grows every single year. And that's quality investing at a reasonable price, and buy it when you can get the building cheaper than 50 million. Let's say it's trading at 30 million because there's some strange factors happening in the market. That's the difference between quality at a reasonable price and cigar butt investing. And we follow the Buffett approach and not the Benjamin Graham approach. What we also don't share with Benjamin Graham, by the way, is his fetish for women. So he had an affair with his son's girlfriend. So that's just an interesting statistic about him. So before we get on to the meat of the presentation, think of this as I work through this presentation. And I suppose the real question is, would Benjamin Graham or Warren Buffett invest in cryptocurrency? Not necessarily would Northstar invest in a cryptocurrency. And maybe this answers, invest only if you would be comfortable owning a stock, a cryptocurrency, a flat, a farm, even if you had no way of knowing its daily share price movement. So that's really the ultimate test of investing, knowing that you can buy something and leaving it alone. And I'm not convinced that anyone I've met that's bought a cryptocurrency leaves it alone. But maybe you can prove me wrong. All right, so that's a little bit on the background, doing justice to the two topics. The third topic is on Northstar. But before I get there, I will hopefully be able to show you a video if it works.
Redskins, I
apologize for the language.
Yeah, Redskins, Dotterheads, tepid lemonade.
I'll take 5 of your Redskins and one of those tepid lemonades.
It's one chicken, mate. It's not a chicken.
No, that's much better than a chicken, my friend. That is gold.
What?
Gold. The currency of the future.
Great, come back in the future.
Redskin, no, I don't think you understand. This has unlimited use.
Can I eat it?
No.
Can I wear it?
No.
Can I use it as firewood?
No.
It's starting to sound pretty limited, mate.
But you can melt it and then turn it into whatever you want.
Can I turn it into food?
No, you can't.
Is this going to take long?
Hold on your horses, mate. We are dealing in futures here.
Ooh, what's that? Is that a rock?
No, worse, it's cold.
Oh, cold. How do I get some coal?
Gold. I have people mining for it.
Oh, you have people. La-dee-da. We've got a rich one here, eh? What do you pay them with?
Gold.
Next.
No, they say that this currency could be worth 1,000 Ratskins, maybe even more, in just a few years.
Says who?
The people with gold. Fuck.
Next. Every economy ever has been controlled by the big chicken banks. Next. And this is our opportunity to get out from under the big chicken boots, shake up the market, and start taking back our economic independence. Are you with me?
No.
Really? Come on, man. Look, all my mates are doing it.
Oh, just get your hand off it, all right?
Everyone's trying to predict the next alt rock.
First it was stone, then bronze, then iron, now gold. What can I even do with this shiny shit? Make fucking jewelry out of it or something?
Yes, Yes, you can do that. Great idea, because it's malleable. And best part of all, there's fuck all of it. It's a finite resource.
Mate, I'll tell you what a finite resource is. My fucking patience right now. Piss off!
You know what? Stuff it. I'm taking it back. It's like talking to my dad.
Yeah. Why'd you go discover avocado and smash it on toast, you dickhead? Sorry, mate.
I'll have a dodo head, thanks.
Half a chip. Piss on me, not you two.
Oh, no. This is way better than gold. It's silver, or as I like to call it, like gold cash. It's faster to mine. It's...
Gotta be the last one, surely. Ratskins, dodo heads, very tepid lemonade. Get it here. Desert warm.
All right, so that's about as far as our understanding of Bitcoin goes. And clearly, that video does give the impression that there is a future for these things. And so we're not here to nullify the potential for Bitcoin. But I think as we go through our presentation, our concern is that that outcome could actually end up being something like this. So there's a positive outcome for Bitcoin, but there's seriously a negative outcome. And the way we manage money, we can't own Bitcoin in our portfolios, and hopefully as I go through the presentation, you'll understand why. All right, my last real point on this is when we look at the Bitcoin, we took a graph of investment speculation over time, which is actually the red graph, and we superimposed currently Bitcoin's share price over it. And all assets have different cycles they go through. And all we can say here is that there's an uncanny correlation with the amount of speculation that's happened in other asset classes over time and Bitcoin. And I'll leave it at that. All right, now our business. And can everyone hear me? All right. Talk about Northstar. And some of the slides I was presenting yesterday to one of our big clients, he said to me it looked like something out of a financial journal. And because they're complex. And my point to you is, please focus on me and not the slide. And I hate to say that, but let me explain to you what the slide says very simply, rather than for you to spend time trying to analyze it. All right, so we were founded in 1996, and Greg mentioned that. Very small firm. A few of us joined in 2012. The firm has grown. Our focus is owning quality companies that are mispriced, quite simply. So there's one other big manager in South Africa that has a similar approach to investing, and I don't know anyone else that adopts it as religiously as we do. So everything about what we do, from the way we screen to the way we invest finally, is about quality at a reasonable price. There are 3 points of differentiation in our firm. For a small firm, we've got a lot of analysts, 8. We've also got a very rigorous investment structure and process, which we've learned over 25 years of doing this. We have a very strong process of bringing new analysts through, and we're busy employing 1 or 2 others right now. And within probably 6 to 12 months, we can bring an analyst up to stream because of the strong process-driven approach that we follow. Our business has grown less out of institutional support and actually in the very high net worth client market with the likes of advisors and supporters like Cinnabar. And our philosophy, which is different to most people out there, is effectively buying quality at a reasonable price. And it's one thing saying that you have a set philosophy, it's another thing implementing it from beginning to end. Now, I'm not going to go through everyone in the team, but you can see we have quite a substantial team. I'm also not going to talk about our product range in great detail now, other than the fact that we have a simple product range. We don't want too many products. We believe in high focus, high attention on less products. We start with an income fund, a managed fund, a global fund where we've done particularly well, and just launched a South African equity fund. Our philosophy is long-term exposure to quality assets where value exceeds price. And I'm going to break this down for you, and you're going to see how mechanically we actually live by our philosophy. And I say mechanically because every single thing we do fits into this philosophy. And we've tested the philosophy too. So it's one thing saying I'm a value manager or I'm a manager that's buying quality at a reasonable price. But have you got the structures, the bricks and mortar that actually live that philosophy? Do you understand how to implement it? So how we start our world is we start screening, and I'll show you some of those as well. So we screen the markets, the South African market, and we screen the offshore markets. Screen about 5,000 companies globally and about 165 on the JSE, actually a few more, the small caps and mid caps. We spent a lot of time reducing that universe to a quality universe. So instead of trying to be involved in everything, we've shrunk our universe to only look after and look at high quality or good quality companies. Instead of trying to buy a deep value mining stock and have it as part of our universe, that's not what turns us on. So we've stuck specifically to identifying a universe of higher quality companies. And offshore, it's about 250 companies that we know a lot about, and 100 South African companies that we know a lot about. So we try never to know a little bit about a lot of companies. Instead, we want to know a lot about a few companies. And our portfolios actually have about 50 companies in the offshore space, and it's 44 companies actually on the domestic that actually have made it into our portfolios. So here's the stuff that CFAs study and people try and work out instead of just listening to the message. So I'm going to make it very simple. Most of you are involved in businesses. So when you want to own a business or buy a business, you need to look for certain criteria that make a business a feasible potential proposition to own. So we look for quality and value criteria. And the quality, we believe a quality business deploys capital or puts money into a business that has a high return over time. So let's think about it. You buy a business for 100 Rand. You have a potential to buy a business for 100 Rand, one that delivers 30 Rand a year and one that delivers 3 Rand a year. Clearly, you should be focusing on the one that delivers 30 Rand a year. That's point one. So that's called return on invested capital, and we screen in block one for a whole lot of metrics around return on invested capital. The second thing is we want cash, and we want cash that's growing. Steinhoff we didn't own, and Greg knows that. And we didn't want to own Steinhoff because there was poor cash generation. We actually had 12 red flags on Steinhoff, but specifically very easy to see. They did not beat their return against the cost of running the business every year. So if you just do a simple graph of the cost of running Steinhoff against the potential returns they were generating, the costs were higher with acquisitions and the returns they were generating. Very simple. It's one of the first things we look for. And the cash generation was terrible. So two key criteria. They didn't meet column one, and they didn't meet column two. Quality companies grow their cash over time. So the first thing we do is we spend a lot of time screening on these first two pillars. We then, once we've identified a universe of companies that satisfy those two quality buckets, we then screen them on value criteria. A whole lot of value criteria that we set. Now, why are we long-term driven? And it's quite simple, because we like the odds in our favor, as you should when you're dealing with clients, and I know you do. So what we did is we back-tested a quality portfolio over different periods, both offshore and here. And here's some interesting information, and it's, you know it anyway, but we just kind of emphasizing the importance of long-term. So we've taken a portfolio of 50 companies, so of 20 companies in this case, high-quality companies, and back-tested them over time. And what's very clear is over 1 year periods in dark blue, the performance is erratic. When we stretch that to 3 years and 7 years, we get very sound, real returns coming out of a quality portfolio. So you could say, yes, but you get the same thing out of the market. If you just stay in the market, you're going to get a good return over 7 years, and that is true. But we then look to see, if you bought quality at a reasonable price and you compared it to the market, would you win? And what we've done here is we've back-tested that same portfolio over time, over different rolling periods. 1 year, 3 year, 5 year, 7, 10, and 15. Dark blue is our quality portfolio rolled over those various periods against the market in gray. And what it tells you definitively, that you do not need to own the market relative to a quality portfolio bought at a reasonable price. Because not only does the quality portfolio outperform the market on the upside, so the best 1 year performance, average performance over time would have been 75% from your quality portfolio versus 73% from the market, but the downside on the quality portfolio is substantially better than buying the market too. So what you're getting here is by buying quality companies at a reasonable price, you're getting better returns on the upside, and you're capping the downside that could happen during any kind of market corrections for your clients. So we are showing empirically here that over all periods, it's better on average to own a quality portfolio bought when the stocks are undervalued than trying to buy resources and all kinds of other stocks that make up the JSE. What's also interesting is if you look at the 5-year period, particularly offshore, once we start going through 5 years, and offshore it's even more insightful. The offshore, the market still gives you a negative return over 5 years, but not the quality portfolio. So over all periods over time, quality outperforms the market both on the upside and the downside. Now I want to make an interesting point to you. If you look at the top block at the top, the block right at the top, we look at the last year, just the last year. And in the last year, quality underperformed the market. You have to ask yourself why. Because the market re-rated on resources and on financials. And quite frankly, although we do own financials, we have a different screen for them, they're not the highest quality businesses. Think of a bank. You stick a whole lot of deposits in, you leverage them up, provide loans to people. It's effectively a sausage machine of risk. That's not the highest quality investment in the world. So yes, banks are good businesses at times, but they're quite cyclical. And again, the screen is an output from our presentation, and it's not worth going into the details of it. But what we do, all those metrics, every single company that we own satisfies the metrics we're looking for. Quality in terms of cash flow growth, historical quality measures on returns, and then valuation. And we score all the stocks in our portfolio from 1 to 5. 1 being a great score, 5 being a weak score on the various metrics that we set. And what you can just see in dark blue is that the companies we own are the very companies that are coming up in our screening. So we're not buying things away from what we tell clients we're owning. And again, a complex screen, but I'm going to explain it to you very simply. What we do is because we score our portfolio against the market, we can see if we're actually doing what we say we're doing. So in the top, we've got the All Share Index, and we've scored it on quality, growth, value score, and a combined score, which is effectively an average of the 3. And 1 is a great score, 5 is a bad score. And what we can see on nearly all the measures versus our portfolio at the bottom, our quality score is 3.1, quality score of the market is 3.7, lower is better. We have a higher quality portfolio than the market. Our growth score, 2.9, 2.8, more or less in line with the market. And our value score, market's at 4.3, we're at 3.9, and our combo score, 3.5 versus 3.7. So what we're saying is that our portfolio is a high-quality portfolio that's growing more or less in line with the market and is very often cheaper than the market too.
That says, you said 1 is best, which means the market's not very good.
It's exactly. The market is repriced. So it's a relative chart as against an absolute chart. And we'll talk, I haven't got a lot on output at the end in terms of our forecasting, but I'll talk openly about what we're seeing in the market's returns going forward. So now what we've done is we've screened the market on quality, we've rated a portfolio, but we need to find we need to be able to assess the underlying companies and what we think of them. And again, a full process we follow, and I'm going to say, please don't look at the detail. But again, it comes down to quality and value. So everything we're doing follows the same structure. So we look at industry. Is it a good industry that a company's in? Does it have a competitive advantage? Are management good? And I want to make a point on management now. We are spending a lot of time dealing with management in the South African market. And Murray mentioned some of the risk premium that's being attached to management of various companies. Now, we don't think, along the line of your question, that the market understands the level of shenanigans that's happening in various companies. So we have exited some businesses where I've got the management of those businesses on a conference call with my full staff around the table, and I'm leading the charge of dealing with that management team on issues that they aren't telling the market about. So there's one particular company that is very well known in South Africa that's got a contingent tax liability of billions that they haven't released a disclosure to the market yet. as an example, we found out about it. How do we find out these things? Well, we don't like insider trading. We don't get involved in it. But we always find someone in the company to talk to. We always do. We always go talk to a supplier. We always talk to a competitor. That's how we're finding out more about companies. And in this particular instance, we went into the accounting finance division of the company and found out that this is happening. We then engaged management directly. And I asked them specifically, I want you to tell me, do you have a contingent tax liability in this particular area? No, we don't. Yes, they do. We know they do. So there's more stuff coming out in the local market, and there are more landmines around that managers need to be very careful of. And that kind of work only comes through when you're spending a lot of time doing detailed research. So we spend a lot of time understanding companies, understanding their moats, understanding the source of it, the durability, the trend in the moats, how management are managing the companies, the incentive structures they have. A lot of companies in South Africa are structured on earnings per share growth. So if you're worried about they keep on doing acquisitions, they're doing acquisitions for a reason. Management are being incentivized with the wrong incentive structures. So a lot of that kind of stuff is going down. Now this slide we've blanked out. And the reason being that it's proprietary information. All right. And what I'm going to tell you is once we've gone through the process of screening companies, identifying a universe of high quality companies, investigating them through that process of moats, management, the industry evaluation, we then come to a group of companies that we really like. We then put it through a special structure which we've created, which is a risk return framework. And we optimize it using simple computing to test whether our thinking as fallible humans is actually consistent with what a computer would weight a company at. So let's say British American Tobacco has high potential returns, and we've got an idea of risk, but there's some noise in the market, so management's natural tendency is to downweight it to 1%. The computer might be telling you, no, it should have 15% in BTR. So this is a process we've built over time, which has played a big role in helping us. All right, now I'm just going to talk to you a few stocks and explain to you the importance of buying high-quality companies at a reasonable price. Here's a stock we do not own, Colgate. And Rory put it up here. He's our offshore manager. And what he's done is he's looked at Colgate over time, the dark blue line. Colgate is the perfect long-term stock to own. 12% annualized return, 30 or 40 years, never cut its dividend. Just a great business. I mean, I think all of you do brush your teeth, so you've got a good understanding of why Colgate is a sustainable business model. But what I can tell you is there are times to own Colgate and there are times not to own Colgate. So the thematic approach of buy and hold, we don't buy into. We believe that you buy a company when it's undervalued but has quality metrics, and you should consider seriously selling it when it's properly overvalued. So here's Colgate. If you owned it through the cycle and you're getting kind of like a 12% return. If, however, you bought it and we've used an EV/EBIT multiple, and if when you bought it when it's cheap, your return suddenly shoots up to 15.2% through the period. Potentially, when you buy it when expensive, your return drops to 6%. So the point is, and on top of that, your potential to lose money over 1 year rolling periods, if you look at the world like that, goes up dramatically by buying Colgate when it's expensive. So yes, over many years, you'll define owning Colgate. But if you do your research and know when it's cheap and expensive, you can actually make money transacting on a company like this. Another one we've owned overseas is Boeing. It did 130% last year. We've had it for 5 years, and what we're trying to show is the importance of cash flow. So one of the two metrics we look for, cash flow. So it's a complex graph, but each one of these lines is how the market has updated their expectations 1 year out for the cash flow of Boeing. Now, Boeing has a very strange way of accounting. When they launch a new plane, they tend to try and smooth out the costs against the plane over time. But a lot of costs go in up front. So when they're selling a lot of planes later in the cycle, they make a lot of money on the later planes versus the first ones, because the costs are quite high up front to build a plane. And the cash flow comes out of Boeing in a very big way later in the cycle. So Boeing, even though it's done 130%, we're still seeing 20+% upside for Boeing. We got, I think, a $418 share price on a target price, and it's $340, $350 at the moment. Just on the local side, we've owned Supergroup for years, and I'm not going to go into detail about it other than to say for every single company, we want to look for management, industry, competitive advantage, and valuation. And we don't have to tick every single box all the time, but we need enough boxes ticked. So the competitive advantage in Supergroup's market is limited. I mean, they're a logistics business mainly. But the industry has been a good industry with consolidation, and management have been excellent. And at times, the valuation has been very cheap. It isn't right now. All right, just a little bit on performance, and then I'll just go into some market views. Our performance, we've got long years of being in the market. And we've had periods where we've been absolutely world-class and periods where we've suffered like most managers. I think what's important is to know when we'll do well and when we'll do badly, rather than looking at it annually like that, just to understand what you're buying. Northstar will suffer when resource shares do 100% in a year. They're just not quality, they're not high quality businesses. But what we've shown clearly empirically is over time, buying the type of portfolio that we hold will outperform the market, and you just got to stay with it. We'll also we'll struggle when banks do very well. Although that said, and I'm talking mainly offshore because they're better financial businesses than banks offshore. Like we own, for example, Blackstone, which is a better business, and some asset management businesses. In South Africa, we don't have that luxury, and we're forced to own some banks. And going into December, we were quite overexposed to banks, owning BGA, Standard Bank in particular, and some Investec, and did very well. Held out we loaded the domestic side because we had quite a lot of rand hedge exposure too. So we made sure that we weren't very exposed in case Cyril did come in, and it worked very well for us. So we've had a very defensive portfolio through this year and done quite nicely out of it. So our income fund has done well. Our balance fund is where we've got the longest history going back to 1999. And we think we've come into our own in terms of managing this fund. Even though it's got a long history of performance, I feel more confident than I ever have without being overconfident on how to manage one of these type of products. Our segregated portfolios have also done well over time, but some of that history is also before us at Northstar, some of the current staff. And then our offshore has been an absolutely world-class area for us. We've got history actually going back to 2012 on our pure equity. This is on a flexible fund. And you can see this is the best peer group in the world and how well we've done against them. And last year we did, I think, 29 or 30% in dollars in the fund. And we're, I think, 12 months rolling, we're 7% ahead of the MSCI currently. So, and we continue to find value offshore. It's an area that we've expressed ourselves very well. And it's quite ironic that a small Cape Town-based asset manager has such exceptional returns offshore against some of the best managers in the world. So what do you get when you deal with us? You might not get African exposure directly, and I think Murray has done fantastically in that space. But what you do get is a very stable business. You get an experienced investment team. I mean, I've done it for 25 years, and I feel I learn every day. But our team has come of age. We've been together for 5.5 years. We've brought up 8 analysts, and as I said, our turnaround time with a new analyst is literally 6 to 12 months. So we're very proud of our ability to take an analyst and bring him right up to speed, or her up to speed, in how to analyze the company. We're very research driven. We have a very focused product range and a long proven track record. So that's really us in a nutshell. I just want to give you some perspective on returns. And I bought totally what Murray said early on about the next year. But we actually have a slightly different perspective. We don't think you can do any timing. We don't believe that you can time markets at all. And that it's hard to aggressively time in short duration. So in our balance fund, we're at 41% in equity, domestically. Our bottom-up work, where we've taken every stock on the JSE and looked at expected returns, just on the sell side, if you look at brokers, they're expecting 20% from the market. If you take the return of all the stocks in the market, you just add up all their returns and you work out, you get 20%. If you take earnings growth, it's going to be about 12% on the market. The PE is 17 on the JSE currently. If you normalize that PE and you take every stock, you go back to its long-term PE average or something you believe is a realistic reflection of that company's potential growth over time, it's lower than 17 on average. When you normalize the P's, you're getting returns of 6-7% out of the JSE for the next 12 months. So that is a tricky space to make inflation plus 5 returns. All right, just at face value, the market's got high expectations for returns, but when earnings are still going to be quite strong, but when you normalize PEs, the returns are going to be much lower. So the question is, does one normalize PEs in the next year? In other words, is the market's PE going to go from 17 to 14 in the next year? So then we asked ourselves that question, so we started throwing a bit of stats at it, and we looked historically at re-ratings in the market on interest rates. So interest rates probably will drop in South Africa. They probably are going to drop. So what does the market do when the interest rates drop? Well, actually, the PE, 80-odd% of the time holds its own or re-rates slightly. But the problem is the P is already 17. 83% of the time, the market has earnings have grown in anticipation of a high P. So so what the market's already anticipating a good year ahead. So the P's gone up in anticipation of a lot of these earnings. Now here's the interesting stat, I think. We then asked ourselves the question, is there any degree of predictability with low interest rates on a 17P that you can say the market's going to go up? And you can't. Only when the P is 12.5 or less on the market can you statistically say that there's a chance of positive returns. That's the interesting thing. So you have to get down to a P of 12.5 or lower before you can say almost a dead cert that the market's going to rise. What we can see specifically of a 17 PE is that you might make money over 1 year, but you've never made money over 2 years and longer. So that's an interesting point. So when you buy the JSE on a 17 PE, you better make sure you're out of it before you pass the 12-month period. So I don't know. That's not a bet I like to take. All right. I don't think I can bet timing the market perfectly 12 months out. So what we've done is we underweight the sector average in our balance fund. We're at 41. The sector's at 45, 46. We're beating the sector purely on stock selection. So this year, out of the 20 top performing stocks on the market, we got 4 of them. And some of them are quite weird, like ACI. We also hold the big things, Old Mutual, BTI, Naspers. But we hold a whole lot of weird things below that. All right. So that's where we play. Just in terms of how we'll do well and when we'll do well, we won't do well when small caps struggle and mid caps struggle. So last year was the worst performance of small caps in the history of the JSE of the data we've got. And yet, small caps and mid caps outperformed the market by a stretch over time. So statistically, I wrote an article at the end of last year in our quarterly bulletin that said, it's highly probable that only a few things have to go right for small caps to do exceptionally well, because they're completely undervalued. Why are they undervalued? Well, they're undervalued because the economy was under severe pressure. If you run a small company and the economy is struggling, you struggle double as much. It's a simple reason. There's operational gearing in small companies. As South Africa improves, which we've already seen in the first quarter of this year, small caps have way outperformed large caps. So our large caps are down 6% year to date, small caps are down 1% year to date. Metrofile, one of the stocks we own, went down to R3.30 and just bolted to R4.10 literally in the last few weeks. So did some of the hospital groups that we own. So we're starting to see the environment for little companies, smaller companies that we think are great businesses to flourish again. So if you're looking at us and you want to understand what's going to drive us, don't own us when you think resources are about to be the best part of the market. Own us if you want a long-term portfolio that will outperform the market. And the evidence is there. We didn't conjure it up for you. And own us if you want a manager that can delve into small companies that no one else wants to go. Metrofile, as an example, generates 30 million rand of cash a month that it doesn't know what to do with. We like that. Those are the type of businesses we'll own on your behalf. Thank you.
We've got time for a few questions. If I can start maybe on offshore stocks, something like Facebook. Is that a quality company? And would it be an interest for your fund? Kind of the tech stocks in the US in particular, the newer one.
So Greg, we had a lot of tech stocks. So here's the interesting thing about quality at a reasonable price. If you look at return on invested capital in segments of markets, the US market has the segments with the highest ROIC, and they happen to be in pharma, IT, and consumer. South Africa has the lowest returning sectors as the biggest part of our market. So if you look globally, return on invested capital is lowest for forestry, mining, businesses, or commodity-based companies. South Africa is one of the markets with the highest concentration globally of the worst performing sectors over history. Just out of interest. All right. So we do own IT companies, pharma companies, and we owned a lot of them. If you look through our portfolio now, some of the consumer staples and that have been obliterated. We've been buying back those businesses. We own Boeing. We own some platform businesses like Danaher, consumer businesses, and we've sold down some of the IT exposure, but we do still own some core businesses. Apple is a good example of a company that we bought like in a massive way at $90 in the portfolio. We've exited a lot of that Apple position at now that it's 170, and I'll tell you why. Because the market at $90 was the implied growth rate in Apple going forward was negative. Crazy. We didn't think Apple was going to be a company growing negatively in terms of cash flow. In fact, the cash flow was going to be very positive. So you don't have to be exotic in markets. Markets give you opportunities all the time. You just have to be aware of where they are. And you have to have the systems and structures to find that. So there's an example of an IT company we've owned and pulled back. We do not own Apple. We've got no issue with the Apple business model. I'm not referring to the morality that's come out in the last few weeks. Facebook. We don't own Facebook, and I'm not referring to the morality side of it. We like the what's called a network effect. So we think business models are very strong when you have a network effect because people don't want to leave that network. So if you've got photos and friends on Facebook, it's difficult to find in a competing platform. And because it's a network effect, the network builds over time. The cash flows out of Facebook are massive, as they are in other ecosystems like Tencent. Tencent, I think, generates $5 or $6 billion of cash flow a year and has $30 billion on its balance sheet. So these companies are very cash generative. And I add a last point, but they don't have much working capital. They don't have a bad working capital cycle, and they don't need a lot of capital. So Buffett, in his last newsletter, said, I missed out. He acknowledged it. He said, the capital light businesses that I missed out on, Google, Apple, Google, Facebook, etc. He mentioned that. So, but we don't own Facebook right now just because of the valuation.
One observation, sir. You mentioned Boeing and actually how the system works. That's not entirely accurate. The biggest problem in the portfolio is
Sure. Absolutely. Yeah. Sorry, the most profitable is? Which one is the most profitable? Yeah, so we've looked at Airbus as well. Just finished the work on it. Yeah. So we like, yeah. Yes, we totally agree with you. So we've looked at Airbus. So we've first owned Boeing, and we think Airbus is, you probably know Airbus has a few issues going on with it at the moment that's causing the share price to be kind of restrained. We think the cash flows are still going to come through. Airbus's accounting is more conservative than Boeing's, and we probably think that once they fix up some of the stuff they've got going with them now, that in about 2 years' time, the markets are ready. So Airbus is up 50% when Boeing's up 130, by the way. We think that there's more potential in the share price for Airbus going forward, but they have to fix some of their issues that they've got going right now. Some of them are military-related issues with R&D in there. Yeah, we agree with you. Yeah. Yeah.
Any other questions?
the income fund slide
Sure.
and explain the dip in November 15th?
Yeah.
Was
So,
that able?
no, not at all. We haven't had any able. No. So it's a very conservative income fund. But when we launched the income fund probably at a very tough time. So these income funds have, call it property in them, corporate debt, government debt, generally in the market. Our problem when we launched, there was no corporate debt being issued, and corporate debt has quite high yields. So corporates come, like BMW, would come to the market. So all our competitors had historical corporate debt in their portfolios at very high yields. When we launched, there was no corporate debt being issued, and when they were issuing corporate debt, they were issuing it at bad valuations. So we had to buy something to get the yield up in the fund. So we bought government debt, and then Nenegate and Provid happened to us. And the government market got hammered, but the corporate market didn't get hammered as much. And since then, as the funds matured and corporate debts come back to the market, we've managed to populate the fund like any income fund. Just more.
No, you don't see that happening.
No, the fund is quite a conservative fund. So we've got some government exposure, like everyone, on the longer end of the curve, because we think there's still some money to be made there. But generally, think of this fund as probably quite a lot more conservative than most funds. Very conservative. Mark runs a very conservative fund. Yeah.
On that slide that showed how you compared to the market, you told us that you try and value the company in various aspects between 1 and 5, and yet you're only 0.2 better than the market.
Yeah, in the domestic market, it's very difficult to be, because there's a limited number of stocks on the market in South Africa, our universe. The market as a whole is most stocks are quite similarly valued at the moment. And I think that's just an issue in time. You'll find that at times the market looks extremely overvalued in certain areas, and we will then look very, very different. So when you back test that over time, there are big differences. At this point in time, I'd say to you it's more an anomaly. In terms of most of the markets, quite similarly valued. Does that make sense to you?
Well, yes and no. The point is, if you're doing all this research, the whole objective is to find companies that are closer to the 1 level.
You're just not going to find them at the moment. We can't change the market dynamics. Take a stock like ACI. We've owned it. So that if we take that back 12 months, the ratings would have been very widely different. But ACI's re-rated was actually one of my slides. I've taken it off. We now think it's fairly priced. And there isn't a lot of value in the market. Hence my starting point that we're seeing 6-7% returns, and we're quite concerned about the market.
Remember, that was just the JSE. So being the managed fund is a multi-asset fund. So you're going to look for alpha in other places where maybe you are underweight locally. You said, and offshore your equity weighting.
Yeah, so we're currently at about 20% total. And what you'll find offshore, I haven't shown the slides, is that because we're dealing with thousands of companies, the differential is much wider in those ratings. I think we're at 2.6 offshore, and the market's at 3.4, something like that. So just domestically, we're struggling in the universe that we've got. We're always going to have that problem, particularly when the market converges on a rating, which is where we are at the moment.